think we're ready to make a start. Thank you everyone for joining us. Let me just introduce myself. My name is Richard Rones. I'm a chartered accountant, but director in Thornton Rones Limited that specialises in business recovery and insolvency related services. This is a seminar on the unintended consequences of the return of HMRC revenue customers as preferential creditors, something I don't think many people have given consideration to the consequences. A lot of people are aware that revenue customer preferential status, which was removed in 2003, September 2003, is returning. What I don't think they understand is the full consequences, and that's what this seminar is, hopefully this presentation is going to explain. So let's get going. So the contents are going to be initially, we're going to try and set the scene of what the order of priorities are in insolvencies, explain each one of those, from fixed and floating charge creditors, next to preferential creditors and who they are, to the prescribed part, which is something probably everyone's heard of, but maybe don't fully understand, but we're hopefully going to make that clear. We're then going to explain the quantum and which revenue and customs claims are returning as preferential creditors. And then we're going to go through a worked example of the danger to your clients, which I don't think has been intended by revenue and customs, but is a real consequence. And then we're going to talk about some impact statements, mainly revenue and customs, how they think it will impact various parts of society, and how it might impact lenders, and obviously, more importantly, how it's going to impact your clients. And then we're going to talk about some mitigation strategies you can introduce to your clients in order to reduce the exposure that this is going to certainly cause your clients, and potentially, and I think this will almost certainly is going to happen, is there will be a number of people out there who will lose their house because of these changes, sadly. And then there'll be a little bit of time for questions at the end. Okay, so let's get going. So here's a very, very simple summary of the order of priorities in every single insolvencies. Now this obviously we're focusing mainly on corporate insolvencies, but the preferential creditors statuses applies to both personal and corporate, and obviously limited liability partnerships, all insolvencies. So just remind everyone, the order in which money flows down from realisations in an insolvency is fixed charge creditors get paid first without deduction. 100% of the monies that come in from any fixed charge asset realisations go back to the fixed charge holder, unless they give permission for the monies to be reused in some other order. Then you get the preferential creditors coming for any floating charge creditors. At the moment, there are some preferential creditors, which we'll run through in a minute. The revenue and customs are being introduced as a secondary preferential creditors. What that means is the ordinary preferential creditors, the current preferential creditors, get paid first. Any money left over then flows down to the next pool, which will be secondary preferential creditors, revenue and customs. Then after that, whatever the net assets at that point are, it goes to this prescribed part. It gets carved out, and a portion of that money goes to unsecured creditors before it goes to anybody who's got a floating charge, normally a bank under a debenture. Then any money after the prescribed part goes back to the debenture holder, the bank normally. If there's any money left over, together with the prescribed part, that goes to unsecured creditors. Then shareholders come last, or just before them. If there's still a shortfall to floating charge holders, they do come in at that point. This is very important to understand. Now, you can see in this graph, in this chart, sorry, fixed charge creditors come first, and then there's a number of other amounts of money that come out, and from these changes for the secondary preferential creditor for revenue and statements coming on the 1st of December, three tranches of monies come out before the money goes back to a bank under a floating charge. So obviously, it's clear that what banks want to do is have their money secured as a fixed charge, so they get maximum amount of money back first, rather than a floating charge. So it is important to understand the difference between fixed and floating charge creditors. And let's do that first, and then we'll move on to the next categories in the pool of realizations. Fixed charge creditors. Fixed charge creditors are over assets which are fixed charge in nature. Now, the important first thing to say about fixed and floating charges is it doesn't matter what the debenture says, what the charge says, the asset dictates the kind of charge you can have over it. So you can't have a floating charge over a fixed charge type asset, and you can't have a floating charge, and you can't have a fixed charge over a floating charge asset. So it's the asset. It doesn't matter what you write in the debenture. It's the asset that will dictate, and that's why when your clients will have noticed debentures have a fixed and floating charge over all the assets of the company, is because it makes sure it just catches everyone in the right category rather than trying to list everything out in detail. So what is a fixed charge? Fixed charge is an asset that can be, and it's practical to do so, can be bought and sold and transferred without necessarily disrupting the business, but it is such the nature of the asset is that it doesn't need, it's practical, it's not a thing that's moving, evolving on a regular basis. Whereas a floating charge asset is changing more regularly than that, and therefore it's less practical and to identify and to get a borrower's permission to deal with it. The example I quite often give to people is a sweet shop example, just because it goes to the two ends of the types of assets we're dealing with. Just as an example, when I'm talking to directors, I sort of say to someone, in a sweet shop, if you want to relocate, you want to sell the premises, maybe move next door, or wherever you want to move to, it's practical to phone up a bank and say, I'm selling the building. I know I've got a mortgage, a fixed charge over the building. I'd like to sell it, and then I need to buy next door. So if I repay monies to you, will you immediately relend them? And then that will enable me to go and buy the premises next door or whatever. And that is a practical thing to do. It doesn't happen overnight. There's a period of time in which these transactions and these finances can be put in place, etc., etc. If, however, I want to phone up, someone walks into the shop and wants to buy some stock, wants to buy a sweet off the shelf for 10p, and I've got an overdraft facility that's secured by a floating charge, a fixed floating charge, but the sweets by nature is an example of a floating charge asset. It's not practical to sort of say, right, Mr. Bank, I've just banked 10p. I'd like to take 5p back because I need to replenish my stock. Is that okay? You need something that is flexible. You need to do those transactions on a regular basis. So floating charge assets tend to be, I mean, obviously the example I've given you is extreme. They tend to be stock, debtors if they just aren't factoring and invoice discounting, which I'll come back to in a second, movable plant and machinery, vehicles, computers, etc., etc. Fixed charge assets are things that can be identified very easily, and therefore the charge fixes on them. Book debts is a bit of an anomaly because it can be both a fixed and floating charge. In the case of factoring invoice discounting, it's a fixed charge because obviously they know exactly every single invoice they've lent against. If it's just a normal loan or overdraft facility, then obviously the bank may know at any point in time that there's £100 of debtors, but they wouldn't necessarily know who owes that money unless they are involved in the business on a very detailed basis. And so the general principle now is that fixed floating charge companies can have fixed charge over book debts, but a normal overdraft facility or loan can't. So it's very important to understand, because obviously, as I said earlier, if we just jump back, you want to be, if from a lending point of view, unless you've got some other personal guarantee or security, you want to have a fixed charge rather than a floating charge. So we just go on that. Now, who are the main preferential creditors at the moment? Well, at the moment, it's mainly employee claims. There are some obscure ones, such as coal levy duties and so forth, but the main ones that we come across in most insolvencies, in most general situations, are employee claims. Up to £800 per employee for monies owed in the last 4 months for wage arrears is preferential, gets paid first, after fixed charge creditors, before floating charge creditors, and all holiday pay. Now, notice and redundancy, which tend to be the bigger ones, are not preferential. They just are unsecured creditors as far as a company is concerned on an insolvency situation, and they rank equally with every other unsecured creditor: trade suppliers, rent, normally rates, utilities, revenue and customs at the moment, etc., etc. Now, I've put this slide up here because this is the relevant date, the commencement of an insolvency is different in different sectors for different situations. Now, I'm not talking about when the insolvency starts, I'm talking about when the preferential creditors are calculated, or all creditors are calculated actually, and when they're and so it'll be important to understand this a bit later on. These are the dates when they are, which is generally the actual date of an insolvency commencing. Not in other circumstances, claims in liquidations, in compulsory liquidations and bankruptcies, such as antecedent transactions, insolvent trading, etc., etc. You can go back, and obviously void transactions go back to the date the petitions were issued, not the date of the actual commencement of the liquidation. However, creditors' claims are calculated from those relevant dates. So, after, if you remember the earlier slide, after fixed charge creditors and preferential creditors, then there's this thing called the prescribed part. Now, ironically, the prescribed part was introduced in September 2003 because revenue and customs were giving up their preferential status. Now, what they did was, if we go back to the order of priority again, we had the fixed charge creditors, preferential creditors, then a floating charge holder, normal overdraft security against the company's assets or loan, etc., a debenture. What happened in 2003 was, and some of you remember if you're as young as me, that revenue customs were preferential up to that point for the last 6 months of VAT and the last 12 months of PAYE. Now, on the 15th of September 2003, that was stopped, and so what that meant was that that sum of money that would otherwise go back to revenue customs now was just being, the only people benefiting was a debenture holder, banks, finance companies at that point in time. They were getting all the benefit of the preferential status of revenue customs being removed. Again, going back to order of priority. So what changed, what was recognised was then, well, that's not equitable. So let's put some aside for unsecured creditors as a quid pro quo for revenue customers giving up their preferential status. This is called the prescribed part. And the amount that was decided on was 50% of the first 10,000 that was available to the floating charge holder, and 20% of any further amount up to a maximum amount of money that could go to unsecured creditors, which was, since then, and had been unchanged, £600,000 of the maximum amount of money could go into the prescribed pot to unsecured creditors. For all debentures issued after the 5th of April 2020, it's been increased to 800,000. So what we're doing there is we're taking out the money that was flowing down after fixed charge creditors, after ordinary preferential creditors, to a floating charge holder. We're just preserving a little band for unsecured creditors, as we saw in the chart earlier. The Finance Act 2020, which came into effect on 22nd July 2020, has reintroduced revenue customers as a preferential creditor, albeit as a secondary preferential creditor. Now, what the thing that I want to just explain here is this is nothing to do with coronavirus situation. This has been talked about from for a number of years, but it was got more and more serious in terms of revenue customers wanting to re-implement revenue preferential status back in 2016-17, and it was actually announced in the budget, the 2018 budget. Now, what revenue customers have been saying for a number of years is the taxes that businesses were deducting and therefore not paying over and therefore spending as they saw fit was denying the public of essential services, because instead of that money going back to fund those services, it was being spent elsewhere. And really what they were deductions made that should have been handed over but not handed over. Revenue customers have just got to the point where they were thinking that they were just being treated more and more unfairly. Now this changed, so they decided to bring back this preferential creditor status. Now the change was meant to be brought into effect on in April this year, 6th of April this year. because of everything that was going on with the coronavirus situation, it was deferred to the 1st December 2020. I thought this might have been deferred again, but it doesn't appear that it is going to be. It hasn't been up to now. So what this secondary preferential status is applying to is all deducted taxes, not taxes of the business itself, all deducted taxes. So that's all VAT, all PAYE, all employee national insurance contribution, all student loan deductions, all CIS scheme deductions. And because it's coming to effect on 1st December, although revenue customers are denying this, actually what it is effectively acting at is a retrospective taxation on insolvencies, on the distribution of money out of insolvencies, because if you have an insolvency that starts on the 1st December onwards, it catches revenue customers as a preferential creditors for all these monies. If you do on the 30th of November, it doesn't catch a penny as preferential. So you can see why a lot of commentators and people like myself think it's retrospective. Revenue customers aren't really agreeing to that, strangely. Anyway, so it doesn't catch taxes on the business itself. So corporation tax and employee national insurance contributions are still ordinary creditors, unsecured creditors. They're not preferential. They rank with everybody else still. But from where the position was back in 2003 up to 2003 from 1986, where 6 months VAT and 12 months PAYE, now it's all VAT and all PAYE. Now this is going to be a significant amount of money at the moment, because as we're all aware, most businesses or individuals will have deferred March's quarter for VAT payments to next year. And obviously, in any insolvency that commences at any point in time is going to owe a quarter of VAT as a minimum, because you won't be paying the current quarter. And there's going to be some PAYE, probably employee national insurance. So this is going to be a significant amount of money. The impact I will explain shortly, but you just have to remember at this point in time in the presentation, that is obviously going to be a lot of money. And it means they've elevated their status. So this significant amount of money now has just jumped up from below floating charge holders to above floating charge holders. And anybody else that my company owes money to, they just suddenly jumped up. Revenue and customs are aware of this, and this the main reason they brought it in, because they were getting upset about so much money not being paid back that had been deducted, and they're saying it's set to rise by somewhere in excess of £185 million a year. Revenue and customs, forever that I've been involved in insolvency, although I don't look old enough, it's probably getting on for 35 years, have always considered themselves an involuntary creditor, and this is really where the driving force is coming from. So let's do an example. As I said, we'll come back to an example. I just want to set the scene. You can scale these numbers up, add noughts to them, scale them up by any factor you want to, but it just makes the point. So we're going to talk about a relatively small company. Let's say the plant and machinery, fixture and fittings, etc., of £50,000, plus there is an order book, so there's some goodwill for the business. Now they're obviously, in my example initially, floating charge type creditors, floating charge type assets. Liabilities of the company are, let's say there's a bank loan, a historic bank loan. I'm not talking about interruption loans or bounce back loans, although there is an argument that these will be caught within pre-existing debentures and potentially pre-existing personal guarantees and same charges, because the fact of the current interruption loan and bounce back loans is the relationship is obviously simply between the bank lending some money to a borrower. And the banks have to make their best efforts to recover as much money as possible from the borrower before they go back to the government and ask the government under their guarantee to reimburse them up to whatever amount is due under that individual loan. Although they weren't allowed to take personal guarantees in most circumstances and charges on property, they were allowed to take charges on other assets, and it is unclear at this time, because it's so new, as to how this will be reinforced, and there is some ambiguity there, I believe. So, however, in this case, with a bank loan, it's £35,000. It's on a 5-year payment term, so the company's coping with it relatively easily. It's got 5 years left. There are some trade creditors for £30,000, normal creditors, trade suppliers, and revenue customers are owed £30,000. So on the face of it, it's not a disaster. They've got £50,000 of assets and an order book, a bank loan over funded and cash flowed over 5 years, and they owe £60,000 creditors. So it's at the moment, in this day and age, it's not too bad. I just want to remind you, fixed charge creditors at the top, ordinary, now after the 1st of December, which is the point this slide is going to make, we're going to get the secondary preferential creditors in there, prescribed part, floating charge creditors, unsecured creditors. So let's look at the example, what would happen. Right, so hopefully you can see that. Now, what we're going to have is, we're going to sell the business for £5,000, maybe back to the existing management, existing owners, into Newco, maybe to a third party, it doesn't matter in this example. This happens before the 30th of November. Of that, £5,000, goodwill is a fixed charge asset, just believe me. So that goes back to the bank without deduction. That leaves a short of £30,000, as you can see. Thereafter, you've got the other floating charge assets of the company. We've got £50,000 of plant machinery, fixture and fittings, book debts, mainly book debts actually in this example, but they've got £50,000. It's going to be some preferential creditors because let's say there's some employee claims. Not even the employees didn't, or not all the employees followed the business. We've got some wage arrears per employee, up to £800 per employee, and we've got some holiday pay owed. £5,000 is probably a reasonable amount in this size business, stick in that category. That leaves net assets of £45,000 after preferential creditors. We haven't got any secondary preferential creditors because the insolvency commenced before the 30th or on or before the 30th of November. Prescribed part comes out next. That's 50% of the first 10,000 and 20% of the balance, £12,000. That leaves £30,000 left over, £33,000 sorry left over. The bank's owed £30,000 on the shortfall brought down. That leaves £3,000 of surplus as it happens after the bank's been paid in full. Now, your personal guarantee, your second charge on your house to the bank, is obviously not going to be called in because the bank's been paid in full from the company's assets. So what happens to unsecured creditors? Well, they've got the £12,000 prescribed part brought down, £3,000 of surplus after the bank's been paid in full, £15,000. Then we've got £30,000 trade creditors, as we said. We've got revenue customers owed £30,000, as we said in the example, and I've thrown in there some employee claims. That's the holiday pay. No, I'm sorry, that's unsecured creditors employee claims, which is all redundancy and all notice, and that's usually relatively large compared to £800 per employee wage arrears and some holiday pay, because obviously notice and redundancy tend to be quite large. Not always, but tend to be. So we've got £85,000 that adds up to now. 15,000 divided by that, 17p in the pound's going to go back to unsecured creditors. What happens in exactly the same scenario after the 1st of December? Right, so what's happened here? If you look here, we've got the same £5,000 here of goodwill being sold. The same £5,000 goes back to the bank under their fixed charge. Thereafter, we've got the £30,000 shortfall. Now, exactly the same scenario, £50,000, we've got book debts come in, or small piece of plant machinery and stock and so forth, and then we've got the same preferential creditors of employee claims. So up to this point, nothing's changed. However, on the 1st of December onwards, £30,000, if we're going to assume all this is VAT, PAYE, employee national insurance, etc., which obviously is the bulk of the creditors. Obviously, corporation tax is going to remain in there, but I'm assuming that's not large since the company's probably been loss-making, otherwise it wouldn't have got into an insolvency situation. And presumably, employer's national insurance isn't that large. There may be some, but it's not going to be significantly large or materially large for this examples. But most of it's going to be VAT, PAYE, employees' national insurance, maybe some CIS, and maybe some student loan deductions. Now, previously it was down here, that just comes up there. So now we've got the £50,000 of realisations from the company's assets, £5,000 to the preferential creditors, £30,000 to the revenue customers now, the new preferential creditor in there. £15,000 now is only left over. Still got the prescribed part coming out, still preserving some of that, that's not been changed. So that leaves us 9,000. It's a lot lower because obviously we've got 50% the first 10,000 and 20% the balance. Now that leaves us 9,000 left to go back to the floating charge holder, bring the 30,000 deficit still owed to the bank after their 35 up here. Now there's a £21,000 shortfall to the bank. Do they get any money back from the unsecured creditor status? No, because they now rank below unsecured creditors. If we just jump back very quickly, any shortfall does come in, but it comes after unsecured creditors now. Oops, I've gone the wrong way, sorry about that. So now we've only got 6,000. The bit we did put aside from the prescribed part, going to unsecured creditors, still got the same trade creditors, still got the same employee claims. That leaves 6,000 divided by 55,000, only 10p in the pound. Going back to the unsecured creditors from 17p. And remember, these numbers are a very small company, so they're going to be a lot larger if you're dealing with bigger or one of bigger insolvencies. And now the directors, shareholders, or any other guarantors are now going to have to pay £21,000 back to the bank, just because the insolvency started on the 1st of December as opposed to the 30th of November. And this situation is going to be ongoing. What can be done about it? Well, if we simply change now or after the 1st of December, the floating charge credit assets of the business to fixed charge assets to the business, we'll talk about how we can do that in a minute, then the bank gets all their money back straight away without deduction in full, because fixed charge assets go to fixed charge creditors first without deduction from anybody. Still leaves a little bit of a surplus, £20,000, still got the 5,000, still got the 30,000. So that leaves a shortfall to revenue customers because they come after the other preferential creditors of 15,000, but they've got half their money back. They've got 50p in the pound in this example. But crucially, more importantly, although there's the unsecured creditors are going to suffer, they get nothing, but crucially, there is no call under the personal guarantee. So a director, shareholder, another guarantor will not be losing their house or having to lose any of their personal assets for money they didn't borrow in the first place. So what is the revenue and customers' view on this? I've more or less lifted this from the revenue and customers website. Economically, they don't think these changes bring back revenue customers. Secondary preferential creditor is going to be significant. Well, the very, very small example I just showed you is showing a reduction of 17p in the pound to 0 in a very small insolvency to creditors generally, to the UK PLC, if you like, to suppliers, trade people in business out there. Individuals, household and families, well, yes, they've recognised the fact that dividends could be reduced to these people if they lend money to their business or if they're in business themselves. However, what they've totally ignored is where banks and other finance companies have taken personal guarantees and securities when they've backed it up by a debenture. So they seem to just think there's going to be no impact on the people at the bottom, people guaranteeing that, the directors and shareholders. Impact on business, well, yes, they're saying that it could receive a reduced dividend, as I said earlier, and it could change banks' lending practices. Well, you know, it's fairly obvious to me it's going to significantly change banks' lending practices. Right, let's continue with revenue and customs impact statement. So looking at lenders and borrowers, well, the legislation applies to all insolvencies after the 1st of December 2020, irrespective of the date on which tax debts were incurred or the date that qualifying charge started or was implemented. So what that means is it acts almost as a retrospective taxation on returns out of an insolvency, because it goes to all monies owed on the 1st of December 2020. It doesn't matter when the revenue and customs deductions or debt was incurred. If it's owed on the 1st of December 2020 onwards, it will get secondary preferential status. So it's important to go back to the slide I talked about earlier about the relevant date and when insolvency started. It's not the commencement of the insolvency per se, it's when the actual appointment date and commencement of liquidation is. Now, the difference I'm trying to highlight here is, and when we talk about the slide right at the beginning of the presentation, It's to do with commencement of insolvency for antecedent transactions or claims and void transactions. Goes back to the issue of petition in compulsory liquidations and the issue of the petition in bankruptcies. However, the claims of creditors is on the date the insolvency actually started. So it's the date of the compulsory winding up order, the date of the bankruptcy order, date of the liquidation, voluntary arrangements, commencement date, agreement date, date of administration, date of the administration of appointment, etc., etc. And it applies to all tax owed on that date. If it's 1st December, it catches it. If it's 30th November, it doesn't. So that's why that slide's quite important for people to understand. Let's move on to voluntary arrangements. What revenue customers say about that? They recognise the fact that it may affect voluntary arrangements. Now, the reason for that is it's going to make it harder for directors and shareholders to offer a reasonable proposal to creditors. Now, to give you a very quick example of that is, let's say we've got £100,000 of creditors, similar to the example earlier, but let's say now it's £50,000 is out to revenue and customs, and £50,000 to other creditors. Now, if you want to offer a return of 40p in the pound, which is a reasonable offer, it's not the best, but it's not terrible either, you need to get £40,000 in the pot over the period of the voluntary arrangement, whatever that period is. Because obviously £40,000 divided by 100 is 40p in the pound. From the 1st December onwards, let's say out of the £100,000 of creditors, 50,000 is revenue, 50,000 is everybody else, including trade suppliers, including employee claims, redundancy notice if there are any, including rates, including pensions, anything you owe money to. So on that date, if you want to get to 40p in the pound to unsecured creditors, now from the 1st of December overnight onwards, the CBA would have to be drafted as paying 100p in the pound to preferential creditors first, because otherwise no money slips down to the next pool, to the unsecured creditors. So that's £50,000 straight off, potentially. Then to get 40p in the pound to the other £50,000 of creditors, you need to pay £20,000, get £20,000 into the pot. So that's 50 plus 20 is £70,000. So now to get 40p in the pound has cost you £70,000, whereas to get 40p in the pound prior to the 30th of November, if an arrangement is approved, it's only 40,000. Now that is going to make CBAs less viable, obviously. Not because people aren't prepared to do them so much, but it's going to cost a lot more. You might have a business that is viable, has had a one-off historical issue that's been solved, and it is still a viable business, but you just can't afford to service the company's debts as they fall due, and if you like, generate super profits of an extra 70,000, but you might be able to get 40,000. Now, these are very small numbers I'm talking about. If you extrapolate these figures out, obviously you can see where the problems come. Also, a voluntary arrangement is called voluntary arrangement because it's a voluntary process. You need to have someone proposing it, and you need to have someone accepting it. I explain voluntary arrangement as almost like contracts. It's an offer and acceptance kind of process. So you don't have to offer it. Now, obviously, it may not be viable, or it may not be worthwhile for the directors or shareholders to pay for them to get so much money into the pot, given the enhancement of the status of revenue and customs, especially given the times we're living in, because everything's so much more uncertain. So it may make it unviable from that point of view, or it just might, in terms of affordability and also drive, it may just not be worth directors or shareholders' while to do a voluntary arrangement. What about acceptance side of things? How revenue and customers look at this? Well, up to 2003, they wouldn't change their preferential status in proposals that distribution. I see no reason why that will change for two reasons. Firstly, that it is a statutory status. This has come into law, and revenue customers don't like to waive their statutory rights, rightly so. And secondly, they also like to be seen as being equitable to all businesses and individuals. If they start treating people differently, they're opening themselves up for criticism. So if they start waiving this preferential status in some CBAs and some IVAs, some not others, then obviously they're going to be criticised, and that sounds not fair and probably isn't. And so they're unlikely to waive their preferential status, I think. Do they partake in all voluntary arrangements? Yes, they do. In my experience, or anecdotally, I've heard that they haven't. And the only times I haven't heard of, apparently recently they haven't, is back in the last recession when they were just overrun. There was too many voluntary arrangements being proposed. They didn't have the resources to deal with them. So unless they were material to the voting, which normally they were, or it wasn't a material amount, then they would obviously focus on the ones that were both those circumstances. Are they doing that now? I've heard they are. We haven't seen it in the arrangements we've done. We haven't done a huge amount in the recession because obviously it's hard to know where we're going. There have been a new CVA protocol issued by R3, which must have been done in conjunction with revenue and customs, I would hope. So obviously they're looking at voluntary arrangements. I believe there's a new policy document coming out, but my experience with revenue and customs, which has a separate department called Voluntary Arrangement Services, that they are very good. They will explain to you why they haven't accepted a voluntary arrangement. And one we did earlier on this year, we actually went back to them subsequently after the proposal was issued and asked to reduce the amount that they were requesting because some circumstances had changed, and the person did have a voluntary arrangement service dealing with it. I spoke to her, explained the circumstances, something had changed in terms of the nature of the business they were doing and their most material customer, and she agreed. And I sort of said, oh, that's really good of you, you know, you've been quite flexible and open there. And she sort of said, well, it made sense. It was a logical thing to do in the circumstances. So generally, I think they're reasonable, but they won't, and somebody won't change their statutory status, and they won't treat taxpayers differently. Moving on to floating charge creditors and unsecured creditors, we saw in my example, yeah, of course it reduced the realisations to them because obviously there's another big pot of secondary preferential creditors diluting the return to floating charge holders. And obviously, when revenue and customers were in the unsecured pot, they got an equal return. Now they're getting all their money ahead of unsecured creditors for a large portion of their claims. So it is going to reduce dividends, obviously. And lenders are going to seek fixed charges wherever possible. Yes, they are. And they're going to review their lending and their security of the company's assets, particularly, which will obviously thereafter affect how they're going to review any guarantees or secondary security they've got from outside of a company's assets, from directors and potentially shareholders. And therefore, it is likely to reduce the available funding they're willing to give. What else might it change as far as their behaviour? Well, it's obviously going to affect overdraft lending, I think. What people often forget, and we saw a lot of this in the last recession, is that overdrafts aren't there just as a pool of money available to borrowers. It's renewable, it's accessible. Now, generally, overdraft facilities are renewable annually. Most businesses in good times don't notice that because you might, it's more or less done internally by the bank themselves, by the lender themselves. But you may get a phone call. You may have been asked to send them your annual accounts, and they may have just stuck it on file. They may ask a question. But in normal circumstances, as long as the overdraft's being run reasonably well, it just gets renewed annually as a matter of course. Now, especially at the moment, and we saw a lot of this in the last recession, they are more formally reviewed, and they're going to be more formally reviewed because of this, I believe. And so you might find, as we did in the last recession, banks getting on the phone to clients and saying, we'd like to step down the overdraft a little bit over the next 3 months or so, or taking it away altogether. Now that's a huge hit on working capital, and it's going to reduce the working capital to businesses. You might even find the banks say, we don't actually want to lend you anymore, we don't want to be involved, please go and find another banker. Or you might find that the banks just take away overdrafts altogether, or increase the security, is really what I wanted to get to there. And they might go back and review security, review the guarantees, ask for additional guarantees or additional security over additional assets. You may have excluded your house before. And if your alternative is by sort of giving up your house or losing your business, you're in a bit of a catch-22 situation. You really haven't got a choice. You will find yourself putting up your house when you might have been less disposed to in the past. Now, that will lead you to be more, or you ought to be more concerned with what revenue and customers' debt is. And the other concern I've got, which we're seeing more and more, is it might push people more to other lenders. Now, there are lenders out there, such as new lenders, I call them, but probably not anymore, Funding Circle and people like that, who aren't so concerned with taking debentures, and they're going to be less concerned going forward taking debentures because of this fact that the debentures are going to phone charge realisation are becoming worth less and less, but they are more focused on personal guarantees and security as their backup, as opposed to any kind of security over the company's assets. Now, in those circumstances, in any event, up to now, and I've seen it quite a lot, is that you should be, you've been probably only gone to those lenders in the first place because you haven't been able to get money from traditional lenders, the bank, because of the fact that they feel that they've been up to their risk levels. Well, their risk levels are going to be less now. Clients are going to be pushed more and more to these, what I'm calling inverted commas, should say, new lenders. And so, just again, an unintended consequence of this change is that if your main lenders, the high street lenders, are going to start reducing the amount they're willing to loan, then obviously we're going to find people going to those kind of lenders in the future. And then the consequence of that is personal guarantees and securities are going to be larger and larger. Now, is that going to impact us generally in UK PLC? Does that mean there's going to be less people going into business, less entrepreneurs are going to be more concerned about, because effectively, in reverse, they are funding these businesses themselves, i.e. by giving them personal guarantee and security? I don't know. We'll have to wait to see, but it certainly is going to have a significant impact, in my opinion. Impact on lenders, a lot of commentaries are going around. Well, lenders may well reduce the total funds they're prepared to lend to a borrower as a result. Obviously, this is going to have to affect on lending and the availability of funding, and this is going to affect businesses. Invoice discounting and factoring is going to become much more popular, or should become, I should say, much more popular, because that means that it moves up those assets to fixed charge status rather than floating charge status, obviously, which increases the return, the percentage return to the lender. Lenders want to review the tax position of borrowers in terms of how much money at any point in time they may be owing to revenue customers for VAT, PAYE, etc., as all this new secondary status. And they may ask for companies to put funds aside. They may ask themselves to set a bank account, put money into it regularly. We don't know at this stage. We will wait and see. And they may want to have representations or other warranties and so forth. And they may want to know more information or be more involved in the information available from the business. I'm a little bit concerned about that. I don't think banks will, because they will be scared of becoming shadow directors, i.e. being too involved in a business and dictating to a company what they should or shouldn't do, or can or can't do, and trying to control the finances of the business to some extent. So they'll tread very carefully there. They're probably more concerned with security and amount owed, rather than getting too involved in companies putting money aside. They could ask for more complex business structures, i.e. different companies set up where money is put aside, where employees are employed in different companies, etc., so it reduces the exposure to revenue customers, as I say, with preferential creditor. In some companies in a group, I said before, they may insist they have tax reserves, they may manage the loans a lot more closely, they may increase their pricing. Sorry, I jumped quickly of their lending just to compensate for the increased risk as they perceive it, and undoubtedly it is. So next, I want to move on to just mitigation strategies. But just to remind you, the whole point of this presentation is focusing on this scenario here, where you've got company borrowings secured by a debenture that is supported by personal guarantee or security on assets owned outside of the company, i.e. personal assets of a director or shareholder, particularly their houses, and revenue and customs are owed some money, reasonable amount of money, and that is obviously, if it's building up, it's getting worse and worse. But it doesn't matter if it's building up, if there is a significant VAT revenue liability at any point in time. So how can this be mitigated? Well, the first one is obviously avoiding an insolvency event. Don't have a company go into an insolvency at any point in time. So just make sure creditors are paid in full. Next, do not incur a large revenue and customers debt. Obvious, again, these first two are obvious. This second point will require potentially a big mindset change. At the moment, most of businesses tend to see revenue and customs as someone they don't have to pay. They don't see them in the same way as they see trade suppliers. They kind of, you know, we all know clients like this. They kind of see revenue and customs as, well, they'll be fine. They'll be fine, you know. And I know we owe money to them, but is it really a liability of the business? And I've forever explained to creditors there is no difference at the moment between revenue customers and anybody else you owe money to in terms of how they rank in the order priority, and therefore from a statutory point of view whether you should pay them or not. After the 1st of December, you need to see them as more than an essential supplier where you have got money owed to a floating charge holder that you've personally guaranteed, because obviously they're going to be coming out of the pot first. And therefore, you need to see them as more than essential, because, you know, unless you want your house or any personal assets to be sold to contribute to revenue and customs without you being able to decide where that money goes, because they've deducted money available to a floating charge holder like a bank, you need to change your mindset and see them as a very important creditor. If there's likely to be an insolvency event, so if you've got clients that are in difficulty in the scenario I talked to you about, then you may want to ask them to consider very, very seriously having an insolvency event before the 30th of November. Now, what that's going to do is obviously it's going to make them crystallise revenue and customs as an unsecured creditor, because that's what they are at the moment. They just rank equally with everyone else after a floating charge holder that you may have personally guaranteed. Whereas on the 1st of December, they suddenly jump up, as we saw in my graph, in my example earlier. So unfortunately, you may want to bring an insolvency forward. Now, that sounds, you know, an awful thing from someone like myself to say, but if it's if the company is unlikely to survive, then obviously it's better to do it now rather than after the 1st of December. I'm not saying you should go around and all good businesses or businesses that have got a chance of surviving, you should encourage these clients to have an insolvency event before the 30th of November. But the ones where it's unlikely or almost certainly not going to survive, and there is a big revenue gap, and there is a debenture, and there is a personal guarantee supporting that, then you need to highlight this to your clients so they can make an informed decision. In general, the biggest one you're going to have to do going forward in the long term is convert your clients' floating charge securities to fixed charge securities, so that they don't end up in this scenario where they've got, because if they've got a personal guarantee and so forth, fixed charge securities get paid first. Or alternatively, look at other off-balance sheet financing, such as invoice leasing, hire purchase arrangements, and so forth, where obviously there's something that's going to be sold to mitigate the liability to that that working capital provider, rather than it just being an overdraft or a loan of some description that's floating charge lending. And this is a bit of a technical one, but very important. If you've got a client who's got a one-up petition issued against them, or is about to, then you might want to consider voluntary liquidation before the 30th of November. Now, this comes back to the slide right at the beginning with where the relevant dates are. Although a compulsory liquidation deemed to commence the petition, it's not for where the creditor's claims are calculated from. The creditor's claims are counted up to the date of liquidation, not the date of the presentation of the petition, and therefore, after the 1st of December, a revenue and customs liability will suddenly become preferential, whereas before the 30th of November, it's not. So if you have an insolvency event before the 30th of November, we're still in current rules. So if you have to do a CBA, do an administration, do a liquidation, etc., before the 30th of November, revenue customs is still an unsecured creditor like everyone else. And therefore, any monies on floating charge assets will go back to the preferential, to the debenture holder. So, in summary, in the short term, carry out a risk assessment on all your clients that you're aware of who may be in this scenario where there is. I think you have to assume all your clients owe revenue customers some money. but you might want to just have a chat with those who've got some sort of floating charge lending, overdraft, no loan facility, etc., that's backed up by a debenture that's been personally guaranteed. And in the long term, highlight to your clients they need to do two things. They need to change their mindset. In the scenario I'm talking about, debentures, personal guarantee from revenue customers being a creditor that may or may not, almost, not quite a voluntary creditor, but that's part of how people see them, and that's what revenue customers believe they are seen as, to one that is the first one that should be paid. And obviously switch to fixed charge lending to switch to get rid of the exposure generally, if you can. Now, I'm just going to talk about this very quickly because this is something else that came came into effect on the 22nd of July 2020 under the Finance Act. It's given revenue customers other additional powers to make any participator. Now, what that means is anybody who's involved in a business, who's benefiting from any taxes not paid over in a business. So it's catching directors of companies, shareholders, shadow directors, advisors, potentially. Some people, some commentators have talked about banks also potentially being caught. I'm not entirely. I can see why, but it's a bit of a stretch to becoming jointly and severally liable for any company tax liabilities. Now, this isn't all taxes, not restricted to what we've been talking to before, all taxes, where the liability arises or is expected to arise from any scenario of tax avoidance, tax evasion, repeated insolvency, penalty for facilitating avoidance or evasion, or where a company has begun or is expected to begin insolvency proceedings to avoid paying revenue customers. Now, this is obviously exceptionally wide. Now, what revenue customers have said is that these provisions have been brought in to change the behaviour of those who are misusing tax monies. Now, they believe a lot of people are misusing tax monies. So they're looking at scenarios where there is an insolvency, or there might be an insolvency, and they weren't paid as they should be, and it was some other reason behind it that wasn't reasonable in their view. Now, they have said very clearly they're bringing these provisions in as a deterrent, but obviously revenue customers are the ones who will decide whether to implement them or not. We've not seen any examples this year because obviously they're in July this year, and obviously at the moment because of the coronavirus situation, then generally everything's on hold as a gross generalisation. But come next year, the scenarios where there's going to be a lot of these potentially being brought is obviously how bounce back loans have been used, interruption loans have been used, whether the deferment of VAT and other taxes potentially, where those monies went, and whether directors, shareholders acted reasonably, and revenue customers. There's a lot of concerns. Revenue customers will be bringing this in. Finally, just before we get on to questions, just highlight the legal bit. But any questions? We have had some questions. I've been handed as I've been talking here, so I will go on to that. I'm not going to open the presentation up for questions generally because we're really pleased with the response. We've had over 70 people dialing in. I can see we've also had Stephanie's cat. But anybody who wants to put some questions to me afterwards, please do. My contact details are there. Thornton Roans Limited, you've got our telephone contact number and obviously my personal email address. I'm happy to help out anybody. Just to cover a couple of very quick things. We've had 3 or 4 questions in. Firstly, do I think preferential creditor status of revenue customers is likely to be deferred again as it was in April this year? I mentioned that briefly. I don't think so. I did at first. I don't think so now, because if it was going to be, I'd have thought it would have been now. They have just obviously extended the general, in some circumstances, not wrongful trading, strangely enough, but all the other temporary provisions they brought in when in March, April this year, they got backdated to 23rd of March. They have all been extended to various dates later in the year and into the new year. This one hasn't and wasn't included in any of that, and there haven't been any discussions or meetings about it. So I think the short answer to that is no, I don't think it will be deferred again now. What else? Revenue customers' attitude to CVA, will they waive their rights? Well, as I mentioned earlier, they They never did before up to 2003. I don't think they will again, for the two reasons I said in the presentation, that it is a statutory status and they don't like waiving their statutory status, and more importantly, they need to be fair, they need to be equitable to all taxpayers. To start waiving it for some, and there will be concerns about them not being equitable to others. So I don't think they will do that. Do they vote in all voluntary arrangements? Well, historically they do. They do partake in every voluntary, both individual and corporate. Will they continue to do so? I don't know. Anecdotally, I've heard that they have begun not to in some voluntary arrangements and leaving it up to other creditors to decide. I haven't got my experiences. They try. The last recession, they because they get overrun. They only voted in once they made a material, could make a material impact on in terms of voting, or it was a material amount of money they were owed. They may, if they suddenly get very busy, they may implement something along those lines, but generally they do tend to partake in most arrangements, and they don't like changing their status. Will insolvency be more expensive in the future? Well, actually, this doesn't change anything like that, because the insolvency practitioner's fees potentially come out prior to preferential creditors, in which case, if there is assets available, yes, it comes out first. It may, if they post it, if people again are in the scenario we've drafted this presentation on in terms of the personal guarantee, personal guarantee behind a debenture, and therefore, if there's going to be a dilution first, then that's always cost people money, just because how the money flows down from one waterfall to the other. But no, I can't see it changing. The cost of insolvency changing in that respect, and I'm happy to discuss that with anybody else in the future. Other than that, I haven't got any more questions, I don't think, and obviously we're running over a little bit, so I'm going to stop there. But if anybody's got any questions, again, contact me at rowns@thorntonwinnes.co.uk or on 0208 489 333. We're here to help any clients or yourself and in any way we can. Thank you for listening.